Hello and good afternoon and welcome to this ICAEW webinar. Today we're presenting how to value company shares, a step-by-step guide to share valuation in association with Valutico. My name is Kat Hearn and I'm a Senior Technical Manager in the practice team here at ICAEW. I'll be your facilitator for today's session. Today we're talking about share valuation and the increasing demand for practitioners to provide this to their clients, and it's great to see so many of you joining us live. Just a few bits of housekeeping before we get into the real detail. Closed captions are enabled for this webinar, so if you do need to turn this feature on, please click the CC on your screen. A reminder that these are always automatically generated, so they might not always be completely accurate. We'll soon be providing a link to the shares in the chat box, and they'll also be mailed out to you tomorrow. Today, our speakers are Paul Resch, who's the founder and CEO of Valutico, Greg Brown, the Director of UK and Ireland Country Manager, also from Valutico, and finally Graham Antrobus, a valuation thought leader from Bruce Strutherland & Co, and he's also an ICAEW member. Today's session, we're going to start with a fireside chat with myself, Paul and Graham, just to help set the scene on the valuation landscape. And after that, we'll have a more detailed presentation from Graham, and then a demonstration of Valutico software with Greg. And then finally, we'll get to some Q&A. So if you have got any burning questions, please do submit them using the Q&A box, which will be available throughout the presentation. We might answer some of the more simple questions just in the background by typing back to you, but obviously we'll save some of the more discursive ones right until the end. But you can add those questions at any time. So let me welcome Paul and Greg to the webinar. I'm going to ask them to both introduce themselves in a little bit more detail, as I realise I've given quite a short intro to them, and then we'll head into a few questions. So Paul, would you like to intro yourself?
Absolutely. Hi, Kat. Thanks for having us today. My name's Paul Resch. I am the CEO and founder of a company called Valutico. My background is in valuations and mergers and acquisitions. I won't be the main speaker today. We're all here to listen to Graham, but maybe as a quick introduction, what we're doing, and I think we even have some slides on that, if I'm not mistaken. Do I go into that now, or does the Valutico introduction come after that?
I think it's just a quick hype, or
quick hype for now, and then we'll get some detail. We'll promise we'll hold some detail for later as well.
Very good. Over to you, Greg.
Thank you so much, Kat. Great to see you again. Thanks so much for having us, of course. Really looking forward to today's session. My name's Greg Brown, and I head up the UK operation for Valutico. So, pleasure to be here. Graham, I'll hand over to you.
Perfect. And good afternoon, everyone. My name is Graham Antrobus, and I'm a business and share valuer at Bruce Strutherland & Co. I'm currently serving as Vice President and Secretary of the International Virtual Chapter of the American Society of Appraisers. I'm also a member of the Business Valuation Resources Panel of the Appraisal Foundation in the United States. And in addition, I'm a Director of the Educational Development side of things at BVI UK. So I'll launch the slide deck, and I think we're also starting off with a poll, aren't we? So hopefully you can all see the slides. Lana, if you can launch the poll for us. And so this first poll, we're basically looking for a bit more information on your background. So which best describes your professional background? 6 options: sole practitioner, small-sized accounting or valuation firm, mid-sized accounting and valuation firm, large firm, corporate finance boutique, or perhaps something else. If you can please pick your options now. And we're just getting the answers in, so not sure this really comes as much of a surprise. So we've got a breakdown of roughly 30% sole practitioners, getting on for 30% small-sized firms, and about 17% coming from mid-sized firms. And that, for me, that's not really any surprise. Paul, you've introduced yourself.
Yeah, I've already done a little extended introduction in the beginning. Over to you, Graham. Maybe a few words about Valutico. So we deliver valuation technology to practitioners like yourself in over 90 countries in the world. But happy to say the UK and Ireland is our single biggest market in the world. I myself happen to be in Vienna, Austria. So if you ever come here and fancy a nice coffee, do let us know. Yeah, and with that, Graham, I think we've got a lot to cover. Over to you.
We certainly do. So we'd like to go into our second poll question now on successful outcomes. So again, Lana, if you can launch this poll for us. And this poll is on what would make today's webinar a success for you? And there's 5 options. So gaining new insights or knowledge, learning practical tips to improve the EMI valuation process, understanding key trends and challenges in share valuation, getting access to specific queries, or leaving with useful resources or actionable takeaways. I think there's about 30 seconds, so if you can all pick your answers. And we've got the results coming up now, and 61% looking to gain new insights or knowledge on share valuation. 21% looking to understand key trends and challenges in share valuation, and 10% looking for learning practical tips to improve EMI valuation processes. So again, that's not really a surprise for me. I don't know if Greg and Paul have any comments on that. So what we're going to cover today then, so we're going to be looking at the share valuation trends, just to set the background. We'll be looking at the share valuation process, which is going to take us into how to write a share valuation report and lots of do's and don'ts for dealing with HMRC SAV. But I think we're going to kick things off with a fireside chat, isn't that right, Paul and Kat?
I think so, yeah. Let's just set the scene and just warm everybody up, I think, and get everyone into the mindset. And if you wouldn't mind, I've got a question ready to kick off, if that's okay. So really, it's thinking about that evolving landscape. So not that long ago, share valuations would have only been undertaken by a very small minority of practitioners. But now we're seeing more and more firms being asked to perform them for their clients. Can you tell us a bit about how that landscape has evolved, how things have changed?
Yeah, absolutely. I mean, I think it's probably fair to say that share valuations, and this is true on both sides of the Atlantic, share valuations were once seen as a kind of a highly specialised field, which were handled by a select group of professionals. But I think over time, things have really moved on since then. And what we've been seeing is an increasing kind of regulatory framework and scrutiny. We've seen accounting standards coming in to change the mix, and also changing tax requirements. And all of these things have come together to cause really a perfect storm of more firms entering into the space and a lot more valuation work. And I think it's probably fair to make the comment as well that whilst this has made valuations more accessible than it was, it's also highlighted the importance of maintaining professional standards and also expertise to ensure credibility of our kind of valuation work output.
Graham, and you being a man of many interests and talents, especially in the valuation world, what got you into this yourself, into share valuation? What's your personal story?
I started out in accountancy, qualifying as a chartered accountant back in 2003. But I've always had a kind of a bit of an analytical mindset. And over time, I just found myself drawn to the challenge of valuing businesses rather than reporting on their historical finances. So that's really what led me into business valuation. But also the ability to interpret financial data, to apply economic principles, and also to consider legal and kind of regulatory frameworks, make valuation all in all to be a bit of an intellectually rewarding and a practically valuable discipline to be part of. So, it's something I've really enjoyed.
Mm.
And following on from that, if I can ask, what's the most popular type of share valuation that you get asked about, and who would that come from? What would your most typical client be?
Well, the majority of our work at Bruce Sutherland & Co revolves around kind of tax-driven work, so particularly things for capital gain tax purposes, inheritance tax, and more recently we've been doing a lot of employee share scheme work. At Bruce Sutherland & Co, we also handle valuations for shareholder disputes, M&A, and kind of a bit of financial reporting work. And typically, our clients include business owners, legal and tax professionals, accountants, corporate finance advisors. All these kind of people are those who will give us instructions for our work.
And I mean, maybe a question from my side, and I'm sure many in the audience are asking themselves too, can anybody do share valuations?
That's the million-dollar question, Paul, I think. Whilst in theory, anyone can attempt a valuation, in practice, it does require some technical expertise. It requires adherence to valuation standards, and also the ability to interpret financial data in context. I think it's probably worth making the point as well that a poorly conducted valuation can lead to disputes, it can lead to regulatory challenges, and it can also lead to tax consequences. So experience and business valuation education do matter.
Definitely an important thing to get right, isn't it? For those who are interested in pursuing this and they feel that they've got the right skills, if you're trying to budget and allocate your resources for your workloads, how long would you say a share valuation project for a particular client would generally take?
Well, the timeline varies based on things like complexity, the availability of data, and also the level of analysis that's required, because no two jobs are the same. A straightforward valuation case may take a few days, whereas more complex cases, such as those involving multiple scenarios, perhaps ones involving forensic elements, can take several weeks or even months. So I think the kind of key point is that no two engagements are the same.
I mean, considering how much work it is and how complex it is, how much can you expect to make from such projects? What's the price range?
Another good question, Paul. Pricing depends on the scope and complexity of the valuation. So it's the kind of whole engagement narrative, the engagement letter that drives that story. A relatively simple share valuation might start at a few £1,000s, whereas more detailed reports, especially those required for litigation purposes, tax disputes, or complex transactions, can range into 5 figures and perhaps even beyond that. The key the one point I would make is that the key factors affecting pricing will include costs, it'll include level of analysis required, also data availability, and also whether there's need for expert testimony or additional work.
And perhaps I'll sneak in one final question, because I'm keen for us to also move on to your presentation. You've mentioned already that there's kind of quite a big regulatory backdrop to this. Is there anything coming up in the near future that you can tell us about that we should be looking out for in respect of those share valuations?
Oh yeah, there's lots of interesting things going on at the moment, Kat. There's currently ongoing discussions around global harmonisation of international valuation standards, and this could impact how valuations are approached across jurisdictions. In addition to that, we've seen the role of artificial intelligence in valuations, which is also gaining traction. A lot of organisations have started to talk about it, but I think it's probably fair to say that until now, no individual organisation has yet taken the lead on the impact of artificial intelligence. And also coming out of the States, so the US Appraisal Foundation is set to release advisories in the coming months on company-specific risk premiums, so that's the alpha part of your CAPM, and also intangible asset discount rates. And history has shown us that developments in the US valuation space will often find their way across the Atlantic over time. So it's I'd definitely say it's interesting times in valuations at the moment.
Sounds good. It sounds like a timely time for our webinar to hit them, with lots coming up ahead. I think if there's no other questions from you, Paul, it makes sense at this point for us to move on to your presentation, Graham, just to give us a little bit more detail, and hopefully that little conversation has just warmed everyone up and kind of got the sort of brain focused on the topic. So Graham, I'll ask you to carry on with your presentation.
Perfect, thank you. So just before we get into the presentation proper then, just one more poll question, if you can launch that for us, Lana. And this one is asking about the purpose that you prepare your valuation report. So what's the primary purpose of the valuation reports that you prepare? And the options are tax compliance, mergers and acquisitions, financial reporting such as IFRS or goodwill impairment, dispute resolution or litigation work, internal decision-making or strategic planning, or other. So if you can all vote now, there's about 30 seconds. And the answer's coming up. And again, that's no surprise to me. 30% saying tax compliance work. So 30% of you doing valuations for tax purposes. 33% for M&A. So that's kind of commercial buy-sell transactions. And roughly 11% apiece for financial reporting and litigation support and dispute resolution work. So again, that's not really a surprise for me. So share valuation trends then. So just to get underway, one of the key trends we're seeing in share valuation is the increasing demand that's been driven by investment activity, mergers and acquisitions. Private equity firms, venture capital investors and strategic buyers are relying more than ever before on formal valuations to support negotiations, stretch their buyouts and facilitate M&A transactions. And as high growth companies choose to stay private for longer, the need for independent, well-substantiated valuations has become even more critical. So that's one of the strands that's currently affecting the increase in valuation work. But what we're also seeing is increasing focus on succession and estate planning, which is what this kind of chart on the right here shows. For family-owned and closely held businesses, an accurate valuation is absolutely essential when planning for ownership transitions, whether that's through intergenerational transfers, business sales, or restructuring. And I think the point to make here is that a well-supported valuation helps business owners to set a fair price for shares, ensuring that succession plans are financially viable and equitable. And it also plays a crucial role in managing inheritance tax liabilities, allowing for better financial planning and also minimising potential disputes amongst heirs. So those have been two kind of major trends. But what we're also seeing, another key driver is the increasing focus on regulatory and tax requirements, changes in tax law and governance standards, both of which have heightened the need for regular and transparent valuations. Updated accounting reporting standards both frequently require companies to provide a fair value assessment of shares to ensure financial statements reflect their true economic worth. And at the same time, we've seen significant improvements in valuation methodologies and technology. So advances in things like financial modelling, access to more sophisticated market data, such as that provided by Valutico, and also enhanced analytical tools and made private company valuations far more accessible and reliable. So all of these have come together to mean that as valuers, we're basically busier than ever. And so that brings us on to the whole point of today's webinar, which is, well, if we are getting busier, how do we go about carrying out evaluation assignments, and how do we go about preparing our valuation reports? And so the challenge and the perceived needs. So a well-supported share valuation is the result of an extensive research, financial analysis, and professional judgment. However, despite the time and expertise that go into the process, our clients often only see the final valuation report. They don't see what goes into the process. And so therefore our clients don't fully appreciate the depth of work behind our reports. This makes the report more than just a document. It's often only the lasting impression that you're going to leave with your clients. So a clear, well-structured and well-reasoned valuation report will not only support your conclusions, but it's also going to reinforce trust and credibility in your work. And so just to pick up on the share valuation process in a little more depth then. So the share valuation process begins with gathering relevant information to ensure a well-supported opinion. And this involves three steps which are set out on this slide. First, we request financial statements, corporate documents, and any relevant business information from our client. This initial data collection forms the foundation of the valuation analysis, which we perform next. We also conduct management interviews, which these days we're doing more and more via Teams or Zoom. And where applicable, we also do site visits. And these provide critical insights into the business's operations, competitive position, and key risk factors that may not be evident from financial statements alone. And finally, we perform economic and industry research to contextualise evaluation, so essentially to ground it in what's going on in the real world. Understanding the broader market environment, industry trends and economic conditions will ensure that we're in fact well grounded in real world factors. And just looking at the information request in the book in a bit more detail, and this slide sets out the kind of things that we ask for at Bruce Sutherland & Co. when we undertake a share valuation assignment. But a thorough share valuation will start with gathering key financial and operating information. And from this list, there's really two things that stand out for me. First of all, the financial statement. So typically we'll request the last 3 to 5 years of accounts. But I think it's definitely worth making the point that valuation is always about what's in the future and what's coming through the windscreen, not what's behind us in the rearview mirror. And to understand what's coming, we need context, and that's where the financial statements come in. And typically we'll look at the last 3 to 5 years of accounts, not to dwell on the past, but to identify trends, assess risks, and gauge financial stability. So really the financial accounts are helping us to form an opinion on what's going on in the future. And the second thing that really jumps out is the shareholders' agreement or articles of association. These documents outline rights, restrictions, and pre-agreed valuation mechanisms which could impact the valuation outcome. Understanding ownership structures and any transfer limitations is always essential when determining share value, especially in privately held companies. So those, for me, they're two kind of really standout items in the information request list. Once we've gathered the necessary information, we move on to the analysis phase, which is where we apply professional judgment and valuation best practice. And so the next step for us at Bruce Sutherland & Co. will involve looking at the financial statements for earnings adjustments. We'll also look at forecasts, which are often refined with our clients' input. Financial statements don't always reflect the true economic position of the business. And so we normalise earnings to account for things like one-off expenses, discretionary costs, and also owner-related adjustments. Once we've done that, we then select the most appropriate valuation approaches and methods. So whether that's an income approach based approach like a discounted cash flow, or it could be a market-based approach such as using comparable company data, or an asset-based approach. The choice is really going to depend on the nature of the business that we're valuing, the financial position, and the purpose of the valuation. And then once we've done all of that, we reconcile the valuation outcome by applying discounts, premiums, and adjustments where necessary. So factors such as minority discounts, marketability considerations, or control premiums can significantly impact the final valuation. This step ensures that the valuation reflects real-world considerations and also the specific circumstances which attach to the business. I wanted to pause for a minute on this valuation approaches and methods, and this is a useful chart which really helps to outline the decision-making process for determining the appropriate method to select. And what this chart does is it begins with categorizing the subject company either as a going concern, which you can see here up at the top, or not a going concern. If the company is not a going concern, the valuation will follow some kind of a liquidation approach, either an ordered liquidation or a forced liquidation, but both scenarios are going to lead us to an asset-based approach using either the book value or the adjusted book value. If the company is a going concern, so we're following down this kind of side of the flow chart here. If the company is a going concern, the next step is to determine whether it's a holding company, such as one that's involved in real estate or investments. If yes, the valuation will typically follow an asset-based or cost approach. And if no, the presence of commercial goodwill is assessed, which is on this box here. If there is no commercial goodwill, we're back to the asset or cost-based approach. And if there is commercial goodwill, so you can see right down at the bottom of this flow chart, if there is commercial goodwill, the valuation will follow either an income-based approach, so that's kind of capitalized earnings or discounted cash flows, or a market-based approach, so that's comparable companies or past transactions. So that's really a very broad overview to the valuation approach. For those who are interested, we've included in the slide deck, and the additional slides that follow on from this will show, the valuation approaches in a bit more detail. So we've got some information on the ongoing concern versus liquidation approach, the income approach, and we tie it back to international valuation standards. An example of doing a discounted cash flow is also in there. The market approach, which is also tied back to international valuation standards and how this plays out too, and the cost approach. So that details in the slides for anyone who's interested in a deeper dive. But I think it's probably fair to say that this is a very broad topic that could warrant a separate webinar. So for now, we'll set that aside and we'll move on to discussing the preparation and the presentation of valuation reports. And so the process continued then. So we've gone out, we've got our information, we've done our analysis, and now we're really into drafting and preparing and presenting our valuation report. So the final stage of the share valuation process will ensure that the valuation is not only accurate, but meets professional standards and also client expectations. Step 7 is all about quality control. So before finalising a valuation, we conduct a thorough review to ensure consistency, accuracy and compliance with valuation standards. Step 8 involves client feedback. So we'll, whilst the valuation report is our own, it's an independent document. Engaging with the client will help us to clarify assumptions, address outstanding queries, and also ensure a full understanding of the report's findings. And then once we've done that, we'll prepare and present the final report. So the report is the primary deliverable and has to be well structured. It's got to be clear, and it's got to be supported by detailed analysis. And since it's often the only document the client's going to see, it has to effectively communicate not just the valuation result, but also the reasoning behind it. So this is all the backdrop to, well, what does the report look like? Before we go on to talk about the report proper, let's just launch our last polling question here. So this is on biggest fears. So Lana, if you can go ahead and launch this poll for us, please. And the question is, what is your biggest concern when writing a valuation report? Is it justifying key assumptions and methodologies? Is it facing scrutiny from regulators or tax authorities? Is it client pushback or disagreement with conclusions? Ensuring clarity and readability for non-technical readers, or defending the valuation in litigation or dispute scenarios? You've got about 30 seconds if you can pick your options.
Graham, if I can interject, what's your biggest fear from that list?
I wanted to ask the same question.
What's my biggest fear? I mean, for me, I've always got a keen eye on key assumptions and methodologies, and I always second guess myself. I mean, I think the way some people come at this, they'll go with one kind of methodology, but I think it's always best to go with at least 2 or 3 and triangulate between them. But we'll talk about that. So we've got 36% saying justifying key assumptions. Well, I get you. I understand you. We've got 20% saying facing scrutiny from regulators or tax authorities. Well, that's understandable. 12% saying client pushback or disagreement with conclusions. 10% saying ensuring clarity and readability, which again is quite difficult. We'll talk about that too in the coming slides. And 22%, and again, this is no surprise, defending the valuation in the litigation setting. I mean, it's that reports can come under quite a lot of scrutiny. So with that then, let's just move on to talk about the share valuation report proper. And what we can say is this: we can say that a well-structured valuation report provides transparency and credibility and ensures that the client and any third parties can understand how the valuation was determined. Valuation reports are typically broken down into the following subheadings, which you can see on this slide, but we'll go into each one of these and talk in a bit more detail about them. So instructions and shareholdings then. Well, the first section of the valuation report will establish what's being valued and under what conditions it's being valued. So we start with the holding to be valued, and it's essential to clearly define whether the valuation pertains to a controlling interest, whether it's a minority stake, as this is going to directly impact the valuation methodology and applicable discounts and premiums. And at the same time, we establish the basis or standard of value. So are we looking at market value? Is it fair value? Is it investment value? Ensuring clarity on whether we are valuing under whichever standard we've picked. All of these points are going to align directly with our letter of engagement, and they'll ensure consistency between the agreed scope and the valuation approach. The next section covers shareholdings and incorporation details. So what we're going to do is document the date of incorporation, provide some historical context on the company's existence and operations. Typically, we'll also include a share cap table to outline the ownership structure, who holds the shares and in what proportions. And I think at this point, it's important to note that for market value purposes, the hypothetical nature of the transaction means that we assume a hypothetical willing buyer and seller, but everything else is grounded in reality. So that really sets the context for us. Section 3 is going to be on class rights. So when valuing minority holdings, it's crucial to consider the rights attaching to those shares, as these directly impact their value. And there's 4 aspects that we typically examine. So voting rights, do the shares carry voting power? Generally, voting shares will have a higher value compared to non-voting shares. Income and dividend rights. So what entitlements do the shares have to profits? Some shares may receive preferential dividends. Others might have restrictions or no dividends at all. Capital rights and rights and exit. So in the event of a sale or liquidation, what claim do the shares have on the company's assets? Preference shares, for example, might have a priority claim in the capital distribution. So all of these things are worth knowing. And also transfer provision. So are there any restrictions on selling or transferring the shares in question? Some shares might be subject to preemption rights, shareholder agreements or lock-in periods, which can significantly affect their marketability and also consequently their value. All of these details are typically outlined in the company's articles of association, which make it an essential document to review in the valuation process. Business background then. So understanding the business background is also a critical part of the share valuation. It provides context for the company's operations, competitive position, and financial outlook. Several factors need to be considered here. So we'll look at the company's history and business streams. When was the company established? What are the main revenue generating activities? We'll also look at the nature of the business and its evolution over time, which can influence things like risk and growth expectations. We'll look at the employee base, so the size of the workforce can indicate the scale of the operations. Larger workforce might suggest operational complexity, whilst a small team might indicate dependence on 1 or 2 key individuals. Competitive landscape, so who are the company's main competitors and are any of them publicly listed? If comparable publicly traded companies do exist, then software such as Valutico can help us to provide useful valuation benchmarks. Customer base and concentrations, we'll also look at who the company's primary customers are and how dependent the business is on them. A highly concentrated customer base can increase risk, whereas a diversified customer portfolio can indicate stability. And we'll also look at other relevant information. So this could include things like industry-specific trends, key contracts, ownership considerations. Any of these could impact on our valuation approach and conclusions. Just to move on then to financial information. So a comprehensive valuation is going to require a detailed review of the company's financial information to assess historical performance, current financial health, and future expectations. It's worth making the point that we'll typically look at a 5-year history to capture a complete business cycle. But this also helps us to identify trends in revenue, profitability, and cost structure. Valuation is all about the future, not what's happened in the past. Management accounts and financial forecasts. So we'll look at recent management accounts to provide a real-time snapshot of the company's financial position. Whilst forecasts also help us to assess expected future performance, which is particularly important for income-based valuation approaches, such as those that are done on a DCF basis. And also normalisation adjustments and profit adjustments. So these adjustments are going to remove non-recurring discretionary items, owner-specific expenses to reflect the true economic earnings of the business. And this step is going to be crucial for comparability and also for accurate valuation calculations. And then this brings us on to the valuation proper then. So the valuation process brings together the financial analysis, the market conditions that we set out. And it really reflects our professional judgment to determine a well-supported value for the business. In thinking about the overall valuation, we'll look at factors affecting valuation. So first, we'll consider specific elements which might influence valuation, including specific trends, including any regulatory changes, customer concentration, any unique risk factors. All of these are going to fall under this heading for us. We'll also set out in detail our approach to valuation. So the choice of the approach will depend on the nature of the business, the purpose of the valuation. The income approach is typically more suitable for businesses that have predictable earnings, where future cash flows drive value. The market approach is typically more relevant, where there are comparable businesses or transactions that can serve as benchmarks. And the asset approach is often used for asset-heavy businesses or where earnings are uncertain. Valuation calculations then. So once the approach is determined, we apply relevant calculations. So whether it's a DCF, whether it's applying multiples or adjusting net asset values. Then we'll look at valuation conclusions and triangulation of values. So we'll reconcile results across different methodologies to ensure consistency and reasonableness. If we're using an income approach, we consider what the valuation implies in terms of multiples of profits. Does it align with market expectations? And if we're using an income approach or market approach, we check how the valuation compares with the business's intangible asset backing. Is the implied valuation consistent with the risk profile and the chosen valuation multiple? Looking very briefly at report types then. So the final valuation reports will vary depending on purpose, level of detail and regulatory needs. And typically there are two main types of valuation reports. So there's summary level reports, which give a high level overview for internal use or preliminary assessments. And then there's detailed reports, which are typically better for kind of tax-driven purposes, litigation purposes or compliance purposes. And also just to draw attention to the fact that formats will include formal reports with schedules and footnotes, or they could be more concise letters and memos. So there is a bit of variability over how we might decide to report to our clients. Report overviews then. So a well-structured share valuation report should be clear, it should be logical, and it should be very easy to navigate. Key findings should be accessible via an executive summary or a conclusion section. And it should also have a logical structure with well-defined sections, preventing excessive back and forthing through the report. Appendices should contain supporting details to avoid cluttering the main report. And reports also do look better for visual elements such as charts, tables, all of which enhance clarity and highlight key trends. As we've said, clarity is key in a share valuation report. So do tailor your communication to the audience in hand, whether that's a business owner, whether it's management, or perhaps even HMRC. Do use precise language to avoid vagueness or unnecessary complexity. Simplify technical concepts without losing accuracy. And above all, know your reader. Technical audiences are going to expect detail, whilst business owners are going to need high-level explanations. Can also make these comments. So the strong valuation report has to be defensible with a clearly explained methodology that withstands scrutiny. It should be comprehensive, so incorporating all relevant facts, even those that don't support the conclusion, to ensure objectivity and balance. And to maintain credibility, the process must be well documented so that another professional could reasonably reach the same conclusion. Every calculation should be well substantiated and backed by sound data and methodology to avoid challenge. And just to make 2 points on quality control then. So a polished valuation report is essential for credibility and professionalism. Before delivering it to the client, we need to ensure that it's clear, it's accurate, and it's well structured. Accuracy comes first, as even minor errors can undermine confidence in the report. Clarity matters just as much, so the report should be easy to read and free from ambiguity. And finally, formatting will play a key role. So a clean, well-organised report will enhance readability. For HMRC, a well-prepared report isn't just about valuation. It has to be clear, it's got to be defensible, and it really has to set out the underlying story attaching to the subject company. And so what do HMRC look for? What are some do's and don'ts when dealing with HMRC? And I think it's fair to make these points then. So HMRC focuses on clear reasoning. They appreciate market-based evidence and also compliance with established valuation standards. So when drafting valuation reports, key do's, I think, are these. Do always provide a clear rationale, justifying key valuation assumptions and methodologies. Do use market data and evidence. Support your conclusions with reliable data, including comparable transactions and industry benchmarks from packages such as Valutico where possible. Do follow good practice, so do ensure compliance with established valuation principles such as IVS, and referencing relevant case law or guidance if applicable. Do explain subjective judgments. So if applying discounts, control premiums, or other adjustments, definitely do provide a well-reasoned justification for them. And finally, maintain a professional style. So presenting findings in a structured, clear, and objective manner. And here's what not to do then. So it's equally important to avoid common pitfalls that can lead to challenge or rejection. And key don'ts are as follows. Don't ignore alternative valuation approaches. A robust valuation will explain why a particular approach was chosen. However, dismissing alternatives without discussion can weaken the credibility of the report somewhat. Don't use unsupported or vague assumptions. Your report should always be grounded in market data, financial analysis, and historical trends as far as possible. Don't use arbitrary figures and overly optimistic projections. Don't omit key financial or business information. So your report has to include all relevant financial data, company background, and risk factors. Missing details could result in HMRC requesting further clarification or simply rejecting the valuation altogether. And finally, don't assume that HMRC are going to accept your valuation without challenge. Even the best prepared valuation reports can be questioned. I thought it's probably worth mentioning 1 or 2 success stories as one of our final slides. So, and this is just a good example of how well-prepared valuation reports have made a real difference for our clients at Bruce Sutherland and Company in recent months. And the points I'd make here are, so quick turnaround. So in one case, we successfully secured HMRC agreements on a share valuation for EMI option purposes within a matter of days. It's probably one of the quickest turnarounds that we've seen for an EMI valuation, thereby avoiding prolonged negotiations and uncertainty for our clients. So that's a good outcome for us. Resolving a long-standing client dispute. So in another case, we stepped in to resolve a valuation disagreement, which had been ongoing for over a year. And by presenting well-structured arguments, we achieved HMRC agreement within a relatively short time frame, bringing the matter to a successful close. Successfully defending valuation. So in another case, we successfully demonstrated the appropriateness of applied discounts and methodologies, which led to a favourable outcome for our client. And finally, reducing tax exposure. So by providing a well-supported and robust valuation, HMRC accepted our report conclusions without the need for further challenge, whilst providing a good outcome for our client. So these are all ways that kind of good, strong drafting evaluation reports will help make things easier in the long run. I think that brings my part of the presentation to an end. So if anyone's got any questions, please do pop them in the chat box and we'll deal with them at the end, I think, won't we, Kat?
Yeah, absolutely. You've got a few really good questions actually waiting for you already, Graham. So you might want to take a quick look. Some of them we might just try and, if we are thinking that they can be answered quite swiftly, we might try and just type an answer, but we'll save a few back for discussion. Thank you so much for that presentation, Graham. Really lots of really useful information in there.
That's no problem at all. Otherwise, it's over to Greg then for the Valutico.
Thank you very much, Graham. Really nice job, very detailed. Thank you so much. So Graham this afternoon has obviously talked about theory and practicality. I'll give a very quick fire demo of our platform. Graham, I think you may need to stop sharing. Thank you. There you go. Thanks a lot.
Graham, and I've tried to cover some of the more general questions already. I left some UK specific ones to you, and then there are some very specific ones. I think I don't know if we can cover those. Maybe have a look.
I'll have a look.
Wonderful. So I'm going to do a shortened demo of our platform this afternoon. So our platform has basically been built, but not just performing obviously share valuations, but probably all the other variety of valuations that you do day to day. So company sale valuations, valuations for succession planning, tax. Some of you may also be doing contentious valuations. The premise behind the platform is very simple. It's cloud-based, where it's very, very powerful. It's very quick and easy to pick up. But of course, anybody that does join us, we provide onboarding training. We really look after you. We will even go as far as helping you with your first few valuations. I've already logged on. First and foremost, what you'll notice very quickly, the more information you provide, a bit like Graham mentioned earlier on about the company looking to value, the better the end outcome would be. So here we obviously encourage you to upload any supporting documentation, pitches, decks, financial statements, and the platform very strategically extracts the core components for the valuation. Then you would obviously name the company. So in this instance, I'm just going to call this one test company. We will obviously give you some leverage here to pop in some keywords, a company description as well, of course. Then you'll pop in what I call the fundamentals about the business you're looking to do the valuation on. So obviously we're going to value something in the home market. I'm going to go something quite traditional, going to value a company in a trading distribution space. You need to pop in the last annual revenue figure. So I'm going to go for something quite run-of-the-mill, quite small and modest, of 4 million. Then you need to pop in the maturity of the business. Depending on which one you pop in here, this will have an impact later on in terms of the platform recommending, suggesting the most appropriate valuation methods. If, of course, even though we're looking at a private company, if you can think of a listed peer, you'd enter it here. This will help you formulate a list of peers. Then you choose the valuation date. Of course, valuations are not just about the present day. You can obviously do backdated valuations. Last but not least, you'll pop in the year end. And I think I've covered this a little bit earlier. These are all of the different types of valuations we can perform. So very comprehensive platform that will tackle most forms of valuation. So actually, obviously, to stay on topic for today, I'm obviously going to do, let's say, a shareholder dispute. Maybe that might be a good one to do. So that's all we need, and away we go. The first part of the process, which will be loading up, is called our qualitative assessment. So again, going back to what Graham said earlier on, this is our kind of fact find. Before you jump into the hard numbers, the financials, you're probably going to have that tea, coffee conversation with business owner, extracting useful soft facts. So the whole idea behind this section for us is to work out our cost of equity premium and a liquidity discount. So this is almost like a SWOT analysis. You can do this with a business owner. It's a good engagement exercise. So you can do this independently yourself. Small is your classic SME, of course. Big would be your larger company and so forth. By the way, you can fine tune this, and you can select your own category titles as well. Next up for us would be the peer selection. One of the things that the platform prides itself on doing is presenting an appropriate list of peers. We give you 20, but then obviously this is where you refine things. Your own professional judgment comes into play. You can obviously remove peers if you want to. You're never going to be left with the original 20. You're probably going to be left with the original sort of 5 or 6. Lots of filters, which I won't go too much into, but this will really help you kind of drill down, find exactly what you're looking for. Most importantly here, point of note, We've got a very comprehensive database on board, which gives you 53,000 companies, all with descriptions, product service lines, financials. You can also check for similar peers. In case you're wondering, we've incorporated or integrated S&P Capital IQ into our system. So the nice draw there is you're getting live Cap IQ data to perform your valuations. Once you're happy with the peer selection, we're going to move on to the next one, which is our business plan. Obviously very important to have the numbers, financials, historical numbers. We cater for everybody, basically. We go through 5 levels of sophistication. So this is a first one is the income statement. That's for your light touch valuation. Then we kind of move up across more and more detailed templates could be utilized. So again, you can craft your very own type of valuation. Once we've obviously uploaded our financials here, there's lots of tabs at the top, again, to keep you on track. Here we've got our net debt bridge, which caters for debt, pensions, cash, non-controlling interest, got relevant valuation relevant cash flows as well. Also adjustments, quite difficult to do a valuation without making some form of adjustment. So director salaries would be a classic example. So you can alter the financials, give the rationale. And finally, we obviously have a validation tab, which is a quick plausibility sense check of the business plan to make sure it's internally consistent. So here we've got growth rates, margins, investments, reinvestment rates. We've got a value drive analysis, which focuses on assets as well. You can slice and dice this. You can choose your level of forecast. So you can do a 2-year, 3-year, 5-year, 10-year forecast out. Historically, you can obviously upload 5 years worth of numbers. How do you get your numbers into the system? Excel. So you continue using Excel in a normal way to do your financial planning, analysis, modeling. But once you complete this template, you'd then successfully load it up into the platform and so forth. Some of you may also do scenarios. Obviously, you've got your base case, top case, worst case. So you can present 2 or 3 end valuation permutations. Once we're happy with the business plan, we're going to move on to the transaction section. This is where we typically house our private company SME data. So your listed deals by date, acquirer, targeted business, all the standard stuff, stake acquired, deal value, and the multiples. Again, very comprehensive filter to help you find exactly what you're looking for, so you can drill down. And yeah, in terms of number of transactions, that's a question that very frequently get asked. You'll have access to 1.2 million transactions. And we also have incorporated another specialist SME database called Bohurst as well, which, yeah, is very, very good. Again, I won't go into too much depth, but as you can expect, you can obviously see transaction detail, show similar transactions and so forth. Obviously, I've done this very, very quickly. I wouldn't advise anybody to spend 10 minutes doing this. You're probably going to spend, you know, a good half hour, an hour coming up to the end valuation conclusion. But obviously, zip through this. This is the end game. We present our results in a football pitch style presentation. I am, of course, showing off. I'm showing you all of the valuation methods that are open and available to you. But naturally, you can pick and choose which ones you deploy within the platform. How to read this endgame page. The orange dot represents the value of the business we've just been looking at based on this methodology. The darker blue range is the peer group range, and the average is here. Okay, and after that, I'm just going to flick through very quickly. We've got our net debt bridge, we've got a discount rate showing you how the WACC's been calculated, and then each of the valuation methods shown above. We go into a lot more granular detail. Once you're completely finished, you can obviously change things. You can override the valuation range. You can interchange between your scenarios. You know, this is not a black box. Everything comes with full source reference and so forth. We even give you a cost of capital page as well. And many of you will be interested in this to see how that WACC's been calculated. Once we're finally finished, we can obviously export in Word or PowerPoint. I'm just going to show you a very quick report, how it would look like being generated from our system. So again, just a sample report. So as you can see, very comprehensive. The yellow is very much the placeholder. This is where you would obviously insert data that you've got from the business owner that perhaps the platform doesn't have. But by and large, the platform is designed to produce 70–80% of the valuation report, and then you would fill in the knowledge gap. So if you fancy a chat, a conversation, a little bit more detail about the platform, then here are contact details, Graham's contact details, of course, on the right hand side, if you'd like to speak with him, mine on the left. If you'd like me to spend a little bit of time with you, running you through the platform, talking about what we can do for you, then please take a screenshot or use the QR code. Very happy to have a chat conversation. Kat, I will pass back to you.
Thank you, Greg. You did that in such speedy time, but really comprehensive and a great way of seeing all the functionality there. So really, really appreciate it. Thank you very much for that. Those of you with a keen eye on the chat box will know that both Paul and Graham have been busy typing answers to some of the more straightforward questions and keeping back some of the ones that we can discuss in the meantime. I'll kick us off with how would you assess the quality of a valuation report if your client is on the other side, so the receiving side of a valuation?
That's an interesting question. I mean, it'd be useful to have some more information as to what the questioner means by having the client on the other side. I mean, I can answer, I suppose, a little bit more generally. I mean, we often see valuation reports crossing our desks, which have been prepared by other firms. You know, quality is always variable. You see on the one side, you know, the kind of work coming out of the big four and mid-tier firms, which is typically always supported and always has something behind it. And on the other side, you see some people who probably haven't, you know, do maybe 1 or 2 valuations a year, and it shows. In any valuation report, if you're assessing quality, the things to look out for is whether recognised approaches have been followed, and whether recognised standards have been followed. Is the report in compliance with things like IVS or IPEV if it's in the kind of M&A field? Is it in compliance with recognised approaches and standards? That will be the hallmark of the quality, I think.
Thank you, that's helpful. We've got a few techie questions in terms of what discounts to apply. So I'm going to fire a few of them at you. So we always come across a range of discounts to be applied to minority shareholding. What determines whether the max discount is applied or the minimum discount?
I would have picked the same one, Graham. I don't know if you noticed there was a similar question earlier. I guess you have lots of discussions around this topic too.
We do. I mean, I think it's probably fair to say that, well, there's 2 ways really to calculate discounts that we see here in the UK. One is, you know, you'll see people coming out with very scientific ways of calculating DLOMs and DLOCs, and they'll be supported by things like option models, so things like the Finity model, the Chaff model. Pre-IPO studies, I think I've seen those still being used amazingly, in restricted stock studies. So you'll see people coming at it kind of rather mathematically from that side. But we also see discounts based really on convention, based on kind of scales of or ranges, because this is what HMRC expect, and these are the kind of ranges that we've often gone in with. So at the moment, I think it's probably fair to say we're seeing a mix of convention and calculation, but valuation is always within a range. Valuation is never black and white. There's always arguable ranges, I think.
So what's the typical range then? Because I gave an indication, and I'm curious what you would say.
It will depend on the size of. I mean, if you're talking about conventional ranges, it's always going to depend on the size of the holding that you're looking at. Which makes it really difficult to assess apart from on a case-by-case basis.
Yeah, I see you avoided my question, but
politicians
it makes sense. It makes sense. Yeah, it's difficult.
I am running for election at the American Society of Appraisers, so.
I'm going to continue with another technical question, this time from Richard regarding valuing groups. So are there any different rules or methods that apply? And he's suggested that you would normally have 1 or 2 top companies and then 3 to 6 subsidiary or operating companies underneath that. He's asking if the sum of the net relevant parts are acceptable to HMRC in a share swap arrangement.
Again, very specific questions. I mean, typically, I suppose, if I was approaching a group, I'd be separating out the holding company from the kind of main trading company on the basis that the main trading company is going to sit probably somewhere in the bottom of the structure. I'd look to revalue the trading company in the books of the holding companies it sits above. So that's probably going to be my kind of approach in this kind of scenario. The sum of the net relevant parts acceptable to HMRC. I mean, if by that what we mean is we're revaluing the trading company in the books of the holding company, then that's the kind of approach that I think HMRC might look for. But again, it's worth making the point that valuation is never black and white. It's always in context, and it always depends on the facts and circumstances that you're looking at in the case that you're dealing with.
We've got a couple of questions in there that are specific to the Valutico product. So I'm just going to ask Paul to type in the contact details for those two. And I'm going to pick one final question. And I will just say before I ask the final question, those questions that we've not managed to get to, we're going to capture them and we'll try and follow up with you after the webinar, because I do appreciate that we've had loads of great conversation and lots of good questions here. So I'm going to ask one final question on the valuation report. So the valuation report, does it have more detail on explaining the method and the reasons for a client who does not have that basic underlying knowledge of valuation, but would like to know it in basic, simple language? And what's the value for someone to sort of write that into their report?
Perhaps I can say that very briefly. So the answer is yes. All of our valuation reports have source reference points, and in our Word or PowerPoint export, we've got very detailed explanations, really detailed explanations. So, and it's in very straightforward language as well. But then also our clients have the option to continue using their own existing templates as well. So if you've already got a template, you're happy, comfortable with it, we can help incorporate that into the platform as well. So yeah, so please don't think that the valuations you do have to be big, sophisticated. We can produce, we can make the DEN report customized and very much bespoke.
Thank you, Greg. That's great. Well, as I said, I feel like we've run out of time for any more Q&A there, and I do apologise to those questions that we've not managed to get to, but we will try and follow up on those after the webinar. Can I end by saying a huge thank you from ICAEW to Greg, Graham and Paul. I think we've had a really informative session there. We've crammed a lot of information in there. So I'm sure we've given our delegates and our participants lots to think about and follow up on. Before we do finish, I'm going to put in a small request from ICAEW. In the chat, we are posting the QR link to a member survey to capture any thoughts that you might have ahead of the spring statement. So if you would like to share any of your thoughts with ICAEW on that, please scan the QR code that's coming up in your chat so that you can have your say. We have mentioned already, there's been lots of good information in this webinar. The webinar has been recorded and we'll send the link to the on-demand recording for you tomorrow. And we'll also include a copy of the slides and the contact details for if you do want to have a conversation with Valutico as well. You'll also from there, of course, be able to add the webinar to your CPD record. You can have up to an hour of this as your CPD, which we know is obviously very important. And then the final thing for me to say is we will be sending a short feedback form at the end of this survey. It's always really helpful if you can give us some feedback. It helps shape our future sessions. But we do really hope that you have enjoyed the session. And thank you very much for coming along. And thanks again to our speakers. Bye, everyone.
Thanks, Kat.
Thank you for having us.
Everybody.
Thanks, Graham.